you stay up to date on what's happening in the investment world, you'll notice a lot of hype around direct indexing. It's not a new investment strategy. In fact, it's actually been around for many years, but advancements in technology have increased access to direct indexing solutions. So today we're going to discuss the basics of direct indexing, some of its pros and cons, and who we've seen benefit from it. But first, welcome to my channel. I'm Sean Stevenson. I'm a CFP professional and a wealth associate at Confluence Financial Partners. My mission with this channel is to simplify the complexities that come with wealth for business owners and for retirees. So let's get into it. So what is direct indexing? It's an equity investment strategy where individual stocks are purchased that make up an index, such as the S&P 500. The power of this strategy is being able to trade individual securities while remaining fully invested, rather than just holding a share of a mutual fund or an ETF that tracks an index. The key to success with this strategy is the improvement in technology, because individual securities are bought and sold on a daily basis, which allows the investor to recognize intraday losses but remain fully invested in the market. So what do I mean by this? Let's say you own Pepsi as a position in your direct indexing strategy, and if Pepsi's down 5%, the model would automatically sell Pepsi and buy Coke, which has similar investment characteristics, such as the sector and return profile. But it's able to recognize that 5% intraday loss while keeping your asset allocation the same. This allows for far more tax-efficient investing in a taxable account because you can capture capital losses to offset future potential capital gains, but your dollar always remains invested, and that's really the key in this. The reason this strategy wasn't widely known or used before was because how labor and time intensive it was. So it's very costly, and that usually only made sense for the ultra wealthy to use. With the improvements in technology, select broker dealers and investment firms have made it commercially available to most types of investors. In addition, the tax efficiency of this approach allows for greater customization and control of your portfolio. Now, let's discuss some of the pros and cons of this strategy. 3 pros are the tax-efficient trading in transition. Being able to recognize intraday losses to offset future capital gains makes it a very tax-efficient way to invest. Also, it's great if you have an account with a lot of capital gains that used to be managed by an old advisor or an old investment manager that you no longer wish to stay in. Because direct indexing is able to realize those losses, you're able to offset those large gains that you have in your account. The second pro is the ability for values-aligned investing, meaning an investor can be ultra-specific in certain sectors, industries, or even down to the company that they wish to or wish not to invest in, whether it's for ethical or financial reasons. Another pro is having an experienced professional management team. Since each broker-dealer or investment firm that offers a direct indexing solution, they're going to have a professional team that's highly regulated to ensure proper management of your funds. Now, just with everything in life, there are pros and there's cons. So let's look at some of the cons. It's difficult, if not impossible, for self-doers due to the complexity of managing a large number of individual stocks, which can be complex and time-consuming. Not to mention the fact that you're trying to do intraday buying and selling, and without cutting-edge technology makes this strategy almost impossible to do for the everyday investor. Another con that is associated with the strategy is that there are going to be fees involved. You'll have a flat management fee directly from the investment firm that operates the strategy, but you can also incur a fee potentially from your financial advisor that might be implementing the strategy for you. Another con is that it's really best suited for high net worth investors. It's not ideal for small investment accounts, and in fact, most firms have a $250,000 investment minimum just to implement the strategy. So you might ask, who could direct indexing be suited for? And the answer is, it could be anyone, but ideally it boils down to 4 types of investors, which are high net worth individuals, investors with significant assets that can benefit from the tax efficiency and the customization offered by the strategy. You also have tax sensitive investors, which are looking to minimize their tax liabilities through tax loss harvesting. You also have investors that are seeking customization to be able to tailor a portfolio specifically to their wants and their needs and exclude certain sectors and industries. And you also have business owners that, although not guaranteed, you're able to build up enough capital losses year over year and carry them forward so that if you were to sell your business or sell equipment within your business and incur a capital gain, that capital losses from this account could be potentially used to offset those capital gains. So in summary, direct indexing can offer significant benefits, especially in terms of tax efficiency and customization. But it also comes with increased complexity, cost, and management requirements. So thank you for watching. My vision is to continue growing this community by bringing our team's knowledge and experience directly to you. So I hope you enjoyed it. Until next time, happy planning.